Good afternoon, everyone. It's December 11th, 2015. In this week's video, I'll review the S&P 500, crude oil, uh, the euro. I'll also share with you a couple of charts that hopefully will drive you to make better investment decisions and avoid making costly mistakes. But before I do so, I want to give you a quick overview of our most recent performance. Since the website was first launched on June 1st, 2015, stock and option trades have returned investors, on average, 3.6%. If you compare this to the S&P 500 over the same time period, the S&P 500 has returned investors with a negative 2.8% return. Now, 2 points. First, this does not account current open positions, and number two, it does not account for today's decline in the S&P 500. So if you factor in today's decline in the S&P 500, but do not, of course, factor in current open positions, we're actually outperforming the index by more. Uh, Again, these are not measures and results I'm particularly proud of, but the fact that we were, or the fact that we managed to eke out a small gain for the year on a realized basis, is comforting enough. I think that if you're a well-managed portfolio, could return even in an environment where the S&P doesn't do much, as it clearly was the case this year, you can still earn returns north of 10% as long as you are, of course, dedicated and have a strong work ethic. But more importantly, I think you have to understand markets for what they are. I think that's one of the biggest humps most investors and traders sort of try to overcome, but don't quite get there. I know myself, I'm still having trouble with that, but it's part of the learning curve. It's part of the learning process. Secondly, I also want to draw your attention to the new blog post, which is up and running. To be brief, I basically asked the question if there's a potential change in the tide in commodities. And the reason I felt compelled in asking the question was because earlier this week, Kinder Morgan slashed its dividend by 75%, and Freeport McMoran, another giant, suspended its dividend altogether. Now, part of what characterized 2015 was the fact that market essentially castigated or severely punished companies that either cut their dividend or canceled it altogether, and more so to companies who were levered with levered models. In other words, companies that need to access capital markets, debt markets specifically, to operate their businesses. So the fact that Kinder Morgan and People McMoran actually rallied after the fact led me to believe could there possibly be a change in mentality and as a result a change in the overall sort of trend to this market. Um, and while I'll acknowledge that part of this, these two events could be isolated, right? They could be treated as anomalies and nothing more. I'll still, keep a close eye on this into 2016 because, you better bet there's more companies likely to slash their dividends or, eliminate them altogether. So if we see a similar reaction as we saw in Kinder Morgan and Freeport McMoran, then perhaps that's a way of the market telling us that equity investors are beginning to find value in some of these companies. Now, that doesn't mean these names are going to rally, especially when the price of crude oil is likely to remain lower for longer. But it does mean that much of the damage, at least to the downside, has already been done. So if you're interested, make sure to read the blog post. I'll have a second blog post up next week, and it'll be the second and final blog post of the month and the year. So with that said, let's take a quick look at the charts. First, the S&P 500. Before today's gap down, markets were really range bound between these two time rates, which I've included for the past month now. Today's gap and subsequent sell-off really opens the possibility and really calls into question the move we got off the October lows. Now, that doesn't mean you go out and short the markets right here and now, but again, it is a little bit unsettling to see the markets trade lower and for essentially volume to percolate or achieve such high levels going into the lunch hour. So what I'm trying to get at here is, I would take this with a dose of caution today's decline. If you were waiting to nibble into some stocks, you could still do that. But, from what I've seen today and really all week long, is that people are selling every rally, and they're really not stepping in to buy in the bid. It's a very similar trend to what we've seen take place in biotechnology ever since we got that break in late September. So just be mindful of that. Again, and I've said this a million times, the speed of the trade has changed, and you as a trader have to accommodate for that accordingly. If you don't, and you think the market is just going to continue to rally, you're just lying to yourself and you're not doing yourself any favors. Just be mindful of that. As for price, I mentioned how 207.60, 205, and 197.01 and 198.06 on the spiders are the three big support points to watch for. I mentioned how the only way there's going to be positive resolution to this range, be it by year end or in 2016, is if 207.60 spiders gets reclaimed, contested, and then price proceeds to take out the current 52-week high at 2132 S&P 500. If the S&P trade held above 205 spiders, roughly 2045, then you still have to get the benefit of that to the bulls, but no uptrend or no new uptrend would be confirmed. And then only a break below 198.06 and 197.01 on the S&P on the spiders would really call into question again the move we got off the October lows, but only a break below this year's lows, which were set in October, and correspondingly below the lows set a year ago, also in October, would really set the stage for a bigger sort of waterfall decline. To the downside, I've noted how 1660 to 1680, 1540, and 1460 are levels to watch for. Again, I'm not insinuating nor predicting such an event will take place, but I have to keep an open mind and watch if it's going to take place. I have to trade it accordingly and adapt. But those are just the levels I have to keep in mind if in case market weakens further. As for crude oil, I mentioned last week and the week before how it just didn't look good. I offered 1191 as a potential level where we could see an inflection point, but because 1191, as drawn here, is a fib extension, and by nature fib extensions are not support and resistance points, you should not treat 1191 as an area of support, more so as an inflection point. And the fact that the market just sliced through this point leads me to believe there's more weakness ahead, or at least crude oil is likely to stay lower in the very, very near term. The next level, not support, but the next sort of important point to take into consideration is $10 on the USO. If that level, for whatever reason, is contested, be it by year end or in the first quarter of 2016, that would peg Brent crude at $34, $35 and WTI between 30 and 31. So just bear that in mind. I think crude oil is going to stay lower for longer. It doesn't necessarily mean we're going to see continued declines. It's just that there's not much on the fundamental side, and much less so on the technical end to really sort of want to drive you to buy crude oil. At the same time, I wouldn't short crude oil because A, much of the move has already happened, and B, it's a crowded trade, and I tend to sort of stay clear of crowded trades, even if they're to the upside as well. But here, what I've shown you here is a chart which shows U.S. oil production. As you can see, there was a strong rally starting in mid-2012 and into late last year. And we come to think about it, even though a lot of rigs have been idled, U.S. oil production continues to stay at a very high level. Saudi Arabia has been very adamant in their stance in that they're going to retain their market share. They're not going to let U.S. shale producers corner the market just as Saudi Arabia did back in the 1970s. So they're completely content sitting on their hands and permitting oil to trade between $30 and $40 for the next 3, 6, even 12 months if need be, until U.S. oil production declines. Now, what could possibly delay this? Next year, supposedly, there's this thing called frac log, and basically this refers to wells that were perforated but never really produced any oil, right? And by some accounts and some measures, some of this frac log, which will be streamlined back into production next year, could add as much as 200,000 barrels a day of production. When you consider how there's roughly 1.5 million barrels of overproduction a day, if you add another 200,000, then you're adding 1.7 million barrels a day in overhang, in overproduction. And then the wild card is Iran. How much oil they're going to pump into the market? And again, I've read some estimates as low as 2 to 300,000, and some as high as 1 million. So even if you take the middle figure, right, roughly 600,000, you're talking about 2 to 2.5 million barrels a day in overproduction in the crude oil market, unless Saudi Arabia cuts production meaningfully. It's just, I mean, there's no way. What essentially Saudi Arabia has done going into 2016 is put a ceiling, and a very firm ceiling at that, at roughly $40 to $45 barrel. Only will they allow, in my mind, how I sort of view things. Only will they allow crude oil to trade above 45 once they see U.S. oil production decline notably. Until then, I just don't see much upside. And again, technically, there's not much to go on, and that's part of the reason I just rather stay scotch free from this from USO or from crude oil. And as for the euro, last week's ECB meeting and the ECB's decision to lower the deposit rate to negative 0.3% sort of stabilized the trend in the euro. And I mentioned how really the only way I would short the euro was if 104.61 was taken out to the downside on heavy volume. That did not take place. Or if, and this was the higher probability trade, if the euro traded above 107.81 and as high as 108.68 and then closed back below 107.81, giving us a sell signal. And then from there, I would add on a trade, or add to my short on a trade below 104.61 for a trade to parity or slightly below parity. So the fact that the euro is now trading at 110 against the dollar, as thought-provoking as it may be to short the euro, we don't have any signal and confirmation of a continuation of the trend. Until that happens, again, you're better served just not trading the euro for now. I still stick to my initial estimate of the euro hitting parity against the dollar in late 2016 or sometime in the first quarter of 2017. Obviously, that could change depending on what the market does over the next few weeks and months, but that's what I'm thinking as of now. So for the euro, it's hands off. Really, what we've seen is a sort of the downtrend neutralized. But as for the downtrend being over, it's not over by a long shot. And finally, I want to sort of end this week's video by talking a little about the bond market, specifically as it relates to the one-year yield on U.S. debt and the one-year yield on German bonds. Everyone has their eyes fixated on next week's Fed meeting. I've read a few people saying that a Fed rate hike is not yet discounted. It's still possible the Fed decides to postpone a possible rate hike until 2016. But based on what the market is telling us, a rate hike has already been discounted, and it's evident here in the move we've seen in the one-year U.S. yield. The short end of the bond curve, whether it's notes or 1, 2, 3, 5-year bonds, those are that's part of the curve that's most responsive to a change in interest rates. Whereas the long end of the curve is least responsive, right? So whenever you see short-term U.S. yields, bond yields, rise relative to long-term yields, that it's a way of the market, again, not only telling you that or discounting a Fed rate hike or the beginning of a Fed hike cycle, but it's also telling you that economic conditions have improved and they've stabilized, and that's represented in part by the flattening yield curve. So what you're seeing is institutions selling short-term paper, right, and reallocating those funds into the long end of the curve, and what that creates is a flatter yield curve. Flatter yield curve means growth is going to be retarded or is going to be restricted somewhat because of higher interest rates, right? And you can see this through two different channels, be it the trade channel or the financial services channel, right? But be it as it may, The flatter yield curve means that U.S. growth is going to remain sticky, in my view, between 2 and 2.5%, but closer to 2%. And being that U.S. growth rate is likely not to accelerate on a consistent basis, that is above 3.5% anytime soon, especially if interest rates rise, then it's very hard for me to see U.S. interest rates 2, 3, 4 years out staying above 1.5 to 2%. Because think about it, if you have U.S. growth at 2% and interest rates are inching closer to 2%, you're going to choke off productivity and kill the economy. That's not about to happen. So what I'm trying to get at is U.S. interest rates are likely to stay between 0 and 1.5% for a very long time, and there might be even a time as we approach 2020 where interest rates are going to have to be cut again next year. So just be mindful of that. So that's really all I wanted to say. A lot of people worry that if the United States begins to, or the Federal Reserve rather, begins to raise interest rates, that's going to sort of change the dynamic to the trade we've had. And it's completely true. We're entering this new regime where we're going to see rising interest rates coupled with a stronger dollar. And we really haven't seen that in a long time. If the Fed moves in December next week, it'll be the first rate hike since in over 8 years or 7 years. But we haven't entered this new regime of again a rising interest rates and a stronger dollar in over 18 years. So many of new traders, myself included, who haven't been around that long and haven't been exposed to this new regime of a rising dollar or a stronger dollar rather and rising interest rates may be in for a loop. But again, if you're determined, dedicated, if you want to understand markets for what it is and respect markets, then you'll do well. You shouldn't be afraid of all of a sudden, oh my God, there's a new regime and I don't know what to make of it. No, just study the facts and you'll do okay. But it's something to certainly be mindful of and take into account because it will affect the trade we've seen all year long. That's on the U.S. end, but you have to remember that the rest of the world is easing. This year we saw Turkey, the ECB, Finland, Sweden, Switzerland, Canada, Australia, all these countries, and there's many more that cut rates that sort of offered. They essentially stimulated their markets one way or another, whether it be through a cut in the deposit ratio, in the reserve requirement ratio, in the Fed funds target, the main benchmark, or even if they introduced legislation for new sort of or for the potential of new infrastructure bill for some of these emerging economies. Whatever it may be, the rest of the world is easing, and the only part of the world that seems to be raising interest rates is the United States. And it makes sense. The United States was the first to enter this easing mode, and it's certainly going to be the first, and in my opinion, the last to raise interest rates. Alongside the UK, the UK could also follow suit. But long story short is you want to stick to companies that are U.S. centric. In other words, companies that derive most of the revenues and sales from within the United States. Companies that are cash rich, and most importantly, cash do not depend on their accessibility to the debt markets as a way to fund projects and day-to-day operations. So that's part of the reason why stay clear of energy companies. And this doesn't just apply to MLPs, which is basically that's the structure of an MLP. But that's really all I wanted to say. So next year is definitely going to be the most important week left of the year. Anything can happen. I'm not even going to attempt to say what's going to happen. But we definitely have to keep a close eye to what the market does. Again, the fact that the S&P 500 cannot catch a bid and every sort of rally gets sold into speaks to the ongoing indecision in the market. And on days like today, it's clear that some of these micro makers, bigger institutions, are colluding and they're working the order books essentially to drive prices lower and forcing people to pay for what is conceived to be a better price, but all they're doing is really just ratcheting prices lower. I don't know if it's a way of repositioning themselves long before the event, which I've seen often, or if in fact this is in fact selling and there's just no bid or incremental bid to really push markets higher. So because of that, I'm not going to give an opinion as to what the markets will do next week. I'd much rather see and give a firmer sort of advice after the fact. So with that said, I want to thank you for taking time to watch the video. Please, please stay nimble. Whatever you do, please do not trust markets. What the market give it, it will take it away the next day in a blink of an eye. Believe me, I've been I can say this firsthand because I've had it happen to me a zillion times, and it's part of the learning process, part of the learning curve. One day I'll understand this, but it just please remain nimble. Please be super cautious, especially with this gap down. And I'll talk to you next week. Oh, one last thing, and I'll remind you guys next week. Next week's video will be the last weekly video of the year. As you all know, and as I already told you, I'll also post a blog post next week as well. So next week's video, I'll sort of take everything into perspective and give you a more broader view of what to expect for the last 2 weeks of the year and into 2016. I've decided to take the last 2 weeks off, so I'm not going to be posting any blogs or conducting any weekly videos. However, I will, on the first week of January, you can expect to see a new blog post as well as a new weekly video to start the year. So with that said, I want to thank you for taking time to watch the video, and I'll talk to you next week.